Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for September 17th, 2017. Market is still in bullish normal conditions on an annual basis using NDX 260. We are deeply overbought at 100 out of 100. With the 10-day NDX for the short-term market condition, we are also at overbought at 98 out of 100. In the market mosaic, price with respect to the 200-day moving average is green bullish at 4.91%. Slope of the 50 improved to white neutral at 0.32. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off, and that's currently at 1.074, so we are in risk on conditions, favoring long side and growth potential targets. Take that score of 1.074, compare it to the last 5,000 trading days, and we compute the risk z-score. We're at 0.73. Standard deviations above the long-term average. You can see the 90-day histogram of that indicator right here. We were as low as -2. We've come almost to 0.1. Anytime this goes to an extreme and rolls over, we have favorable conditions for swing trading, and we can actually see that when we look at the market health check. You can see you go back 10 days or almost 20 days, and the market bottomed out. Risk Z began to climb back above the zero line, and that this has been a very good swing trade in a bull market. In blended monthly rebalancing, you can see our holdings here favoring the overseas in Latin America, emerging markets, and in this case Australia, or Brazil, Latin America, and emerging markets. XLV makes the case in ETF 22, that's the healthcare. And then you can see the current leaders in the clubhouse as of Friday's close of business. The internationals are still doing very well. Technology is beginning to creep in the U.S. with the QQQ and XLK. That's the S&P spider for technology. The leaders among the symbols, you can see down here in the Dow 30 and the ETF 200. The exposure in ETF 2 in the theoretical model is back up to 100%. Looking at the ETF 13 and 32 portfolios for blended monthly rebalancing, you can see Latin America, emerging markets, technology are leading the way on the blend. Pretty good performance here in Latin America, and then we'll see down here also in Brazil. That's why it's on our radar screen all the time for both swing trading and position trading and intraday trading. Everything is above the line here in the buy column in ETF 13. That's favorable strength for the market. Same is the case with the exception of consumer discretionary and agriculture in the ETF 32. And you can see how Brazil is really dominating on the 1 week, 1 month, 3 months, and 6 months. In ETF Max, you'll see a lot of Brazil internationals, solar, diesel, copper miners. That's a good sign. Although with copper miners, what we've had is a really nice run up over the last 3 months, starting to cool off here on 1 month and certainly on 1 week. So that may be one where we can start looking at a commodity to start rolling over, or at least buying quality on a dip. Shifting to the market health check now. These vertical blue lines are 0, 10, 20, and 30, 40, 50, and 60 days worth of look back. The horizontal red lines are levels where price had once been resistance and then found support. These act as price targets on the way down if the market begins to roll over. Now, we were able to exceed and maintain above this purple line, which was the previous swing high based on the dragon hump. And you can see the slope of the 10-period regression channel and the 30 are both have both recovered from this 20 days of sell-off, where it found support here, and now has made new highs and held them going into the weekend. I consider that to be favorable. The slope of the 30 is not an extreme yet. You can see it's at about 0.10. It got as high as these slopes on the last surges, so there's still room left in this leg for the market to extend. I've adjusted the percent price oscillator criteria now, the parameters, to 10, 30, and 5, because we've seen some real advantages to doing that. It synchronizes pretty nicely with the RLCO patterns that use 10 and 30 period regression lines, and so this is tuning this indicator up a little bit. And so what I like to see are when the MACD line crosses the 0 line, it crosses its moving average here, and then crosses above the 0 line. That's very favorable, and that would have alerted us in this green circle for this move to the upside, and it's still all systems go. The previous time it did that was here. This is even better because the crossover occurred above the 0 line, and so I see that as a signal for a pocket continuation, and you can see how long that move lasted. This is where that indicator alerted us to a pocket, and a very nice almost 20-day move to the upside here. When this crosses back over on the upside, that's telling you caution, lock in your gains, and that gave a 3 or 5 day alert to this potential. The previous time that pocket was signaled was back here, and the green line crosses above the 0 line. Here's the early the entry signal. You can see that also works when the baby dragon is hooked up, the dragon is up, prices emerge from all that, and you get another nice, again, 20-day move. So here we're 10 days into this move, and it's starting to roll over, coming back towards the 2. So I really see this purple line, which was the previous resistance, is now support. This is how much wiggle room there is for the market to give back before we would be concerned that the move is really over. But for those of us that are participating in the swing, this is a place certainly to ensure that we've locked in our gains. And at a minimum, I would expect you to have your stops around the PSAR or the bottom of the dragon here around 247. I think that would be wise. In ETF2, all of the indexes are above the 4-period monthly moving average, and so that puts us at 100% invested versus 0% cash in the theoretical model. EFA is better at 49 than the S&P at 45, so it's still the globals. You can see the real strength is in Latin America and emerging markets, as we've noted previously, from a different system. So I like that triangulation. Inside the S&P, sector spiders in the U.S., long-term outperformance by technology. That's where the strength is, along with healthcare. Energy is still lagging very much. In the world market model, again, only the large caps are above average compared to the large database. Real strength in Asia, China, everything Europe, and the mid caps and small caps in the U.S. are certainly lagging. Real strength leading the way, Latin America, emerging markets, and Brazil. ETF 30, the top 30, I place Alcoa in there just as a point of reference. It's more volatile, of course, than ETFs, and so it's a tradable entity, has great volume, and because it's tied so strongly to XLB and the industrials, I use that kind of as a bellwether and a reference point. So things that are green in strength and white in consistency or yellow in consistency are signs of emerging strength, because the relative strength of the current reading is better than the 10-week moving average, which is the consistency. So things like biotech, emerging markets are things where strength is beginning to emerge. Same with Brazil. That green and yellow is very favorable for continued momentum. That means we're early in the strength. And then those that are white and green are the ones that are had been very strong over the past 10 weeks, but are now starting to lag somewhat. So this will give us some idea of emerging strength over longer time frames. The liquidity report is just looking at how tradable these are on shorter term bases with ranked by the average daily dollar volume of the last 30 days, and then the relative ATR percentage. If it's green, it's very volatile compared to its peers, so things like VXX, gold miners. Brazil are very liquid and very volatile, making them excellent day trading candidates as well as swing trades. Shifting to the daily report. Again, just a handful of patterns firing. Oops, excuse me. And you can see a handful firing on the auto framer. Lots of good fraud quality numbers in here as volatility continues to decline. Among the ETF 30s, again, lots of good auto framer characteristics here. Metals and mining, Mexico certainly getting my attention. In the daily pinch and stretch report, what I'm looking for in the first column are those prices that have stretched significantly above their own Bollinger Band mean in the middle of the 30-day river. This is the Z-score that tells you where they are in the Z-score ladder. Merck, Pfizer, Energy. We saw energy lagging before, so XLE is going to certainly be one that I look for as perhaps this is maybe the beginning of a short-term rebound. But if it reverts to form and underperforms, then that means that this was a dead cat bounce and could be rolling over. So I'll be framing that trade in that respect. The largest negative Z stretch are the ones where price has stretched below the river the most. Only Travelers is outside of its own river, and that's in the worst condition here for the Dow and the ETF 30. So this is the relatively worst performer in terms of its trade location right now. In column 3 and 4, what I'm looking for is the size or the width of the river. So this looks at the last 30 days of trend. Things that have been very directional are what caused the river to expand, and so ones that are highlighted green or in pink are ones where the river is either very wide or very narrow. And in both cases, we're looking for tradables at the extreme. So Nike and Travelers are candidates for things where their river has gotten very wide, meaning that they have already turned in an exceptionally directional last 30 days. And so that's either going to continue strong or it's going to start reverting to mean, and in either case, we may have found us a critical state in which the trend will either reinforce or begin to decay. That creates a tradable moment in shorter time frames. And then those where the pinch box is most compressed, or the width of the river is the most compressed, then these are ones that are waiting to break out in either direction, and they are exceptionally squeezed. And so that tells us we should be looking at them as Z3P breakouts or straddles. The super pinches are ones in which the symbol is not only pinched on the basis of the width of the river, but where all four of the regression lines that indicate fair value for different time frames are all very tightly clustered together. So that's the RL10, 30, 90, and 270. These are ones then where there's a simultaneous narrow range to break out of, and everybody has acted as if that's the current fair value. So the next thing that must happen is either it just continues on like that forever, or we're going to get a big breakout in one direction or the other. And so that establishes our breakout trade frame that can then potentially lead into a very nice swing trade. So these super pinches on daily charts are one of my go-to alerts for things to prepare for both swing trading and intraday trading. Let me back up. Now when I see EWW, one of my favorite day trading and swing trading symbols, Mexico, is also super pinched, then I'm happier than a dead pig in the sun, because I have something that is continuously a reliable signal for both intraday and swing trading. And so I'm going to be sharpening my knives for that one. Nothing firing in the auto framer of note. The regression line fractal framework, these are the ones where on the top shelf, these are the most numbers of average true ranges above, below their RL270. These are the ones that are at deep value plays, and that looks like trades worth framing. This tells you the number of ATRs that they are above or below. The bottom shelf are the ones that are the most above their RL270. These are the ones I consider to be potentially overheated, and so that trend can stay overheated, but I'm being prepared for a critical state reversion or continuation. So these tend to be your relative strength leaders. So I'm not surprised to see Brazil, for example, in this stack, because it's been so strong, as we've seen from other reports, that it is 6.5 ATRs above his long-term fair value. Now, this is why we should be paying attention to those pinches and stretches, by the way. So you notice they stretch above the 270 double top, crushing down a stretch below. Look how far it is below its own river, the midpoint of its river, almost 4 sigma. And then how far that stretch occurs from the 270, which is this purple line of fair value. And then I want you to notice here this MACD histogram 10, 30, and 5 with its own little 30-period Bollinger Band river. And when that crossover occurs and re-enters the river, this is a good thing. It tells you should be stalking or entering with the swing entry below the swing low down here. You can wait for additional confirmation or add positions when it emerges from the Bollinger Band on the indicator, and that would get you in here. This is actually, and then this is actually, you'll notice a pocket here also, that you have a low, a higher low, and then failure to fail, and it actually takes off again. This is really a dominant entry here in that pocket. And then when you have crossovers and that reverse right here, you get another pocket signal. So we're above the 0 line. Instead of failing back to the 0 line, it begins to reemerge. That gives you another positive signal. That is a continuation pattern, excuse me. That will get you in here. And now notice this amount of stretch above its RL270. That's 6.5 ATR above its own RL270. And so you'll notice also that the degree of this stretch from the RL10 to the RL270 is symmetrical. And so this is another reason to suggest, hey, we're getting close to a trader's maximum excursion here. And so we have had plenty of signals to be on board with this. And this is the time to be respecting changes in the season. Remember, last time it stretched almost that same distance from the RL270. So that's how far it can stretch. And you had 2 attempts at stretch above. Now it actually fully stretched. And so this is a time to stay with the trend, but respect the limits. That's $1 million idea. If you want to look at that on a more conventional chart over at stock charts, then what you have is, notice the crossover below gets you entries in here. When it crosses the 0 line, you have a very favorable signal. This is it failed to fail. And then when it emerges from its Bollinger Band, you can't see the Bollinger Band on here, but when it crosses that 0 line, you're getting entries here at 38. And here's a move up to 40, looks like 43. And now notice, as long as when these little crossovers occur back, back above the signal line, the crossovers that occur above the 0 line are pocket entries, and you can keep going with it. This one still looks very favorable, and this closing action on Friday is excellent. So I'm buying momentum if it continues, starting with the intraday trade, and then I'll keep piling on that swing trade. And I'm using the bottom side of the dragon as my adjustable stop. Nothing wrong with that. So that's the kind of insights you should be looking for, or can be looking for, when you see this regression line fractal framework. These candidates in the bottom shelf then are the ones that are the most overheated with respect to long-term fair value. So that's EWZ was 6.5 ATRs above its RL270. That's what 6.5 ATRs above its RL270 looks like. This stretch above 6.5 ATRs. Now looking at the market mosaic. Again, the S&P looks good on its 30-day regression line slope. You can see the polynomial regression line looking favorable. This is an expanding trend. It's just back to the long-term average here. Notice the crossover occurred over its own 10-period moving average at a distance more than 1 SD below average. That's a sign of a change in the swing. And surprised we get follow through. In terms of percent stretch compared to its own 200-day moving average, we're just getting back towards normal after an extreme excursion. So there's still room to the upside in this market that doesn't believe in success. That's the way I like it. The final thing we'll look at is the slopes of the regression lines, the 10, 30, and 90. So the 10 has emerged from, it's come above 1.0, the Z river. The 30 has recovered nicely. The 90 has started to resume. And so this is the beginning of a potential next leg up. So it's cleared all of this resistance here, which is the edge of the river on daily charts, found support at the bottom of the river, and now has emerged, and for 4 days has remained above the river and didn't fail. This looks very favorable to me. Looking at support around in here. And there's, based on the location of the 30 and 90s slope, there's still lots of room for this to continue. So that's the weekend report. Lots of good things to consider for your trade looking into the week ahead. Keep your risk measured and your powder dry.